Hey there, guys. What is going on? Welcome back to episode number 5 of Inflation Reports. And today we're going to be looking at a very interesting subject. We're going to be looking at the 1970s, the decade of the 1970s, and also we will roll over slightly into the early 80s. But the point being that, friends, the 1970s was a decade of high inflation. And so we want to explore that and what were the drivers of inflation in the 70s, what was going on in the world during the 1970s, and to look for some similarities between those days and the decade we find ourselves in now, in the 2020s. And so then, first I'd like to say that usually I would like to have my face on display in the corner, but unfortunately I can't get my camera to work this afternoon, so not a problem. I hope that people can pick up this channel, and they can, choose whether they want to listen to the content a bit like a podcast, or whether you want to actually follow along with what I might show on the screen. I'm hoping that I can present things in a way that it suits both types of listeners and watchers, So that's all good. So anyway, then let's move on then. So the first slide we have then, inflation in the 1970s. Now, we know that a lot of things went on in the 70s, but just some key images I've got here. So we've got an image from the Vietnam War. We've got an image of a gas guzzling car from the US. We've got an image here of President Nixon, who was very key to economic matters in the 1970s. And we've also got they call this a bobbing donkey, I think, and it's plant and machinery that is used to mine and drill for oil. So then, first things first, then review the US inflation chart. So we're going to take a little look at what inflation was doing in the US in the 70s. And you might say, well, Jake, you're from the UK. Why are you so obsessed with the US? And, well, what I would say to that is this: the old saying goes that when the US sneezes, the whole world catches a cold. And I think, we can use the United States almost as a sort of proxy for the Western world, the developed Western world. Now, I understand that the dynamics are very different for some things. Maybe we might talk about energy a little bit today, and I know that the energy situation in Europe is very different to the US, but of course we'll look at that detail. So we're going to take a look at the United States inflation chart. So we'll just head over to that view then. Okay, then, so what can we see here then? Well, we're back on this inflation chart for the US CPI. We saw this when we were chatting last week in the last video. And the period we're interested in is this decade period here with these two spikes. Now, this was from the low. Now, from the low up to the high, we had the low put in 72 at a rate of 2.5%. We had the first high put in 74, 12%. Second and final high put in 1980, 14, or call it 15%. And then our low didn't come back in until June of 83. So what we want to do is explore this a little bit, and I think the key point I want to make about the 1970s for those who are watching is we can see here from where things started to get volatile to the upside. So let's call that August 73. That's when we broke out at a rate of 6%, CPI of 6%. It wasn't until really May of 82 where that level would be broken down from to the downside, and that inflation would stay low. I mean, we really had, yes, we had this correction in inflation in 76 and 77 where it was a little bit lower, but really we had sustained inflation higher than 6% for pretty much the entire decade, pretty much from 73 until 82, of course excluding the little deviation where we had some low inflation in 1976, 1977. So what I'm trying to suggest is that we've got to be prepared for potentially a decade of high inflation. And when we look at what's going on in 2022, and of course this rally in inflation started in June of 2020, we've got to be mentally prepared. Well, what if this goes on for for 10 years. And of course, the narrative out of the central banks and out of the governments was it is going to be transitory, inflation will subside, it's a temporary phenomenon that we're seeing. But, history doesn't always suggest that. And who's to say that this spike couldn't last for a decade, just like it did in the 70s? And so then what I've done, very briefly, is I've taken a fractal from the low to the high, and I've extrapolated that fractal from this decade, and I've put it onto where we are now. And this shows that if the fractal were to be respected, it shows that inflation could come up to as high as 10% by 2023, and then perhaps we come down for a correction, but then we could break out again to even higher inflation towards the back end of the 2020s. So maybe that would look something a little bit like high inflation. Maybe then the government does something. Maybe they have either tight monetary policy, high interest rates, or maybe even price controls or something like this that might bring the rates down. And then maybe then they go back to easy money, take away price controls, and then we just carry on with the trend of high inflation. Just an idea, not necessarily going to happen, but who knows? And so there we go. That was the fractal idea. And moving on very briefly then, what we want to do is examine the relationship between the inflation rate and the federal funds interest rate. So what's really interesting is if I look at this first peak in inflation in 1974, December 1974, inflation was at 12%. That was when it peaked. And if we go over to the interest rate chart for the federal funds rates, let's take a look at 1974 together. December 1974. So we can see that the peak, the equivalent peak in the federal funds rate was in July 1974, which was before December. So July was the peak in interest rates, and then December was the peak in inflation. Now, what does that teach us? What does that tell us? Well, that shows us that the peak in interest rates preceded the peak in inflation, i.e. the rates needed to be high first for then inflation to peak out and then start coming down. Let's see if this follows for the second peak then. So the second peak was during April of 1980. So the second peak in inflation was in April 1980. Now let's see if we go to our peak in interest rates. The interest rate peaked in what looks like, well, there we go. The first there was a lot of strong tight action going on, but if we look in April 1980, there was a peak in interest rates there. They peaked there at 17%, but they would go even higher. They would go eventually, when Paul Volcker would become Federal Reserve Chairman, they would go on to become 18.9% in December 1980, and then they'd even go as high as 19% in 81. 19% interest rates. And just pause for a moment and think, what would it be like if rates today went to 19%? I mean, can you imagine that? Can you imagine paying 19% on your mortgage? I can't imagine paying that. I'd be in a lot of trouble. If that was the case. These are very serious numbers and things we need to be thinking about carefully. Now, I just want to make the point as well that actually Paul Volcker would have been in office during the point when the rates reached the first peak in 1980 and made it up to 17.6%. And you see here that Paul Volcker was Federal Reserve Chair between 79 and 87. So he was the man who had rates up at these insanely high levels. Just to recap then on what we've just looked at, there's some evidence based on the 1974 peak that actually the rise in interest rates must come first, and then the peak in inflation will follow. And that was what we saw for the 74 peak. And then when we looked at the 1980-81 peak, we saw kind of similar. So again, interest rates had to be very high in order for inflation to peak out. And I think that's the real summary of what we've just looked at. The summary is that in order to get inflation to top out in the 70s, we also saw a correlation with the interest rate, being that the interest rate was also very high. That makes us wonder and look to the 2020s and say, okay, do we need high interest rates now in 2020 in order to deal with our inflation problem? What other similarities do we have between the 1970s and the 2020s? Are there any other indicators that can make us think, maybe this decade will be like that decade? So firstly then, war. Now, what did we have in the 1970s? Well, of course, we had the war in Vietnam between the South Vietnamese and the US and the North Vietnamese and the Viet Cong, the communists. Okay, and that war was characterized by guerrilla warfare tactics, and characterized by carpet bombing of the jungle, and use of chemical weapons, of Agent Orange, of napalm, all these terrible things. And now, is it any surprise? We're in the 2020s. Now, we also have a war that has just started, a big war. So this man here, President Putin of Russia, has led Russia to invade Ukraine, and that happened at the end of February. And so we see the similarity here. You know, there was high inflation in the 70s, there's high inflation now. There was a war in the 70s, there's a war now. And we can't say that these two wars are exactly alike. I mean, Vietnam involved boots on the ground, US troops on the ground. We haven't seen that so far yet in Ukraine, but who knows what the future holds. But what I would say is this. I would say that when we think about a war can contribute towards inflation. And why is that? Well, when you've got a war that you're fighting, you're sucking resources and supply of whether it's goods, services, manufacturing, materials, labor. You're taking economic resource away from a nation, and you're spending it on your war effort. You know, you think all these men that went to fight, all the bombs that were produced, what if all of that energy and effort was put into generating productive goods and services that could be used to benefit the lives of average Joe and Jane? You know, you would have a whole load more supply. You'd have a lot more going on the supply side. Whereas when you're fighting a war, you're taking all that economic activity, the labour, the materials, the manufacturing capability, and you're deploying it to the war effort, which is reducing the supply that could have otherwise been available. So maybe that causes inflationary pressures in some cases. When we think about what the war effort takes, it takes a lot of energy. Maybe there's use of certain, certainly there's use of oil and gas. I mean, I've seen some statistics about how much oil and gas the US military uses today. And then we've got the war in Ukraine. So this is very interesting because the West are playing at the moment a very tactical. We're trying to play it tactical. We're using at the moment just sanctions, economic warfare. So the boycotting of this business in Russia, the boycotting of that Russian brand, the inability to do trade with whether it's Russian businesses or whether it's the oligarchs are being sanctioned, or that they were talking about taking certain banks away from the SWIFT system. And so these are more sort of economic warfare tactics rather than hard boots on the ground tactics. So maybe that has a different dynamic, but we will see. So that's a point I want to make, is that we've got a similarity here. We had war in the 70s, and now it looks like we have war also in the 2020s. Let's move on then. Our next similarity, we have energy crisis. So what can we see here? Well, we've got the picture of that gas guzzling car. We've got some oil production going on here. So what looks like a nuclear plant. So in 1973, there was the Arab oil embargo, and this was caused by a war that was going on in another part of the world between some Arab nations and the Israelis, and the US was siding with the Israelis in this war. And what that meant was that the Arab countries said, well, we need to boycott the US, we need to boycott those other Western nations. Anyone that's supporting Israel in the war, we need to boycott. And so they did not allow for the export of Arab oil into the United States. And this caused great inflation in the price of oil. And people were driving these big gas-guzzling cars that did 10 miles per gallon, and they couldn't fill up their cars. And they didn't want these cars anymore. They wanted efficient cars with smaller engines. But during the oil embargo in 1973, the price of gas rose, or petrol rose 300%. Now I think about that figure, 300%, and I say, well, hang on a minute, that kind of sounds like what my energy supplier was telling me the other day when I live in the UK, and my energy supplier is telling me that my gas and electric bill is going up 300%. It's a similar sort of ratio. And so again, this is another similarity between this decade of the 70s and the 2020s, the energy crisis. There was energy crisis in the 70s, and there is energy crisis in the 2020s. And of course, all these things we're discussing are linked. We know that the war is part of the reason why we have the energy crisis. I wouldn't say it's the only reason, but it's certainly a big factor in why we have the energy crisis. And so then let's go on to our third and final similarity between the 2020s and the 1970s. So just to clarify what I mean on this slide before we get into it, I've called this slide Easy Monetary Policy. Now, I know that monetary policy is normally a phrase that is associated with actions taken by the Fed, the Federal Reserve, in the US. What I mean by the phrase easy monetary policy in this context, for the purposes of this presentation, is I mean actions taken by a government, whether it's a government policy or central bank policy or some kind of centralized authority policy or action or rule that changes and has an impact on the monetary system, the cash system, or the economy more generally and more broadly. And it is this, friends, it is easy monetary policy. And so now these images here, I've got a picture of President Nixon with the Apollo 13 crew members. And I've got this picture of these bars of gold. Now, what happened? What happened with Mr. Nixon and the gold? Well, in 1971, President Nixon eliminated what was known as the gold window. You see, after World War II, all of the nations came together, or a number of nations came together, I should say, and formed what was known as the Bretton Woods Agreement, whereby those countries would maintain a fixed exchange rate with the dollar, and the dollar would in turn be backed by physical gold, and those nations would be able to trade in their dollars for physical gold. So the question is, well, why did Nixon remove the dollar from the gold standard, from the gold window? And it must have been because there was fractional reserve banking going on with the gold standard. They must have had issued more dollars than was able to be redeemed by physical gold in the vaults. So you can see how this fractional reserve system has always been a problem, and the paperization of markets, whether it's metals markets, whether it's, even crypto markets, and, anything that is paperized is inherently at risk of being inflated and fractional reserved, and that's damaging for the holders of the true asset, because the true price discovery is not necessarily correct. So easy monetary policy. Now, what I would say is that the 70s, yes, Nixon left the gold standard in 71, which would be deemed as an easy policy. However, we know that in the back end of the decade, when Mr. Paul Volcker, finally got into office in 79, that he was not a promoter of easy policy, and in fact, interest rates went very, very high under his watch. And to be honest, they were pretty high under the previous chair's watch as well. Certainly relative to today's rates of 0, 0.25, 0.5, it's insane to think where interest rates have been in the past and where they are now, and where perhaps they should be if we really want to start fighting inflation. Is a scary thing to think about. So then what is the similarity here? Well, remember, we're talking about similarities. What's the similarity between the 70s and the 2020s? Well, we had easy money when Nixon left the gold standard, and we have easy money in 2020 when COVID struck. And friends, when COVID struck, all the governments of the world went into panic. And we can see here from the Fed balance sheet chart that the Federal Reserve, which is the American central bank, performed QE of trillions of dollars. I think it was about $6 trillion. I couldn't get you an exact figure from this chart, but roughly $6 trillion in response to COVID. And now, friends, I don't want to dive really in this episode into the plumbing of QE or quantitative easing, as it's quite technical, but what I would say is this: broadly, what QE does is it gives central banks the ability to prop up financial markets. In times of stress, they can inject liquidity into the financial system, and it has the effect of propping up a system that is struggling. And really, you ask the question, well, why do they need to do that? And so the inflation comes, I believe, from the commercial banks and other institutions that have already got over their skis with leverage. They're already over their skis. They've issued currency to their customers and clients in the form of loans, and that is where I believe the inflation comes from. And then they get into a pickle, and then the central bank has to inject money into the commercial banks and other similar entities in order to essentially bail them out. I mean, that's what happened in 2008 in the GFC. They were bailed out, wasn't it? We all know that. And quantitative easing is part of the process of bailing out these commercial banks and other similar entities. And so then we could say that in conclusion to this one, whilst the 1970s, we might say that money was actually pretty tight, policy was pretty tight, especially towards the back end. It was tight in one sense, in that interest rates were high, but it was loose in another sense, in that Nixon took the dollar away from the gold standard, away from the gold peg. And what have we seen since then? Well, the gold used to be pegged at $35 per ounce, $35. Now gold is trading for about $2,000 per ounce. So you're talking about a 60-fold increase in the price of gold, or flip it on its head, a 60-fold devaluation in the purchasing power of the dollar. Okay then, friends, so that was my presentation about the 70s. So just to wrap up in conclusion then, we looked at the chart of inflation in the 70s, and we said we must be prepared for the current inflation to potentially last for even a decade. We must be careful when people tell us, oh, it's transitory, oh, it's going away, oh, inflation will be back to normal levels by next year. We need to be prepared. We need to be ready for any situation. And, this could just be the tip of the iceberg. So we need to be thinking about that. And secondly, we looked at the war, and we looked at how there are similarities between war going on in the 70s and war now going on in the 2020s. And we considered the inflationary drivers created by a war. Thirdly, we looked at the energy crisis, and we realised how in the 70s there was an energy crisis, and how suddenly in the 2020s, but now we find ourselves also in an energy crisis. And finally, we looked at monetary policy, and we understood that although interest rates were high in the 70s, that at the start of the decade, Nixon had removed the United States from the gold window and had made money easy. And just as well as that, in the 2020s, we learnt about the fact that the governments after COVID did the most QE they've ever done. and trillions of dollars worth of value was printed across the different nations. And this is an easy money policy, which is I believe, an inflationary driver. So I hope you enjoyed that bit of insight, and I really appreciate all of you who tune in. And yeah, thank you for listening, guys, and I will see you in the next episode next week. Take care. Bye bye.